Okay, a lot of folks always ask me, can they prepay their whole life policy? The answer is yes. We're going to get into that, how you do it, what it looks like, and what are the action steps to get it done. Can I prepay my whole life insurance up front? The answer is yes. We could do it either by creating a MEC, probably not what you want to do. You could do a premium deposit. So let's say, for example, you have a policy that's a 10-year policy and it's $100,000 a year, which would be $1 million over 10 years. You take the $1 million, you put into this premium deposit, and each year that money comes out of the premium deposit to pay for your yearly premium. And yes, you do earn a rate of return, although it's very small, while it's inside that premium deposit. And last but not least, you can create a SPIA. So let's say if you have $1 million, you put into an annuity. That annuity each year kicks off, I'm just making up a number, $70,000, $80,000 that could be used for your contribution to your cash value whole life insurance policy. So we just talked about the three scenarios that you could do. There could be other ones, but I'm just kind of giving you a little something to think about. Schedule of premiums, not like term. All whole life insurance policies come with a schedule of required premiums. The insurance term for the schedule of premiums is the premium payment period. And it's often a defining feature of a whole life contract. However, I just share with you strategies where you can supercharge it or turbocharge it. All right, folks, check it out. You have various schedules, and these are specified in the policy, whether it's a 20-year or a 60-year. If you look at various whole life products available for sale, you might notice that they make references to a paid up at age or a specified number of years before being paid up. For example, you might find a whole life paid up at age 100 policy, or a 10-pay whole life policy, or life paid up at 65. So just to keep it real simple, let's say if you have a paid up policy at age 100 and you're 40, that means you got to pay premiums till you're 100 years old. Or if you're still 40 years old and it's life paid up at 65, you got to pay the premiums till you're 65 years old. Or if it's a 10-pay, no matter what age, you pay the premiums for 10 years. Now, that's for them to be paid up. However, because of the way whole life works, a lot of agents out there, they'll sell the life paid up at age 100, knowing that the insured, you, may stop making payments at age 70 or 80 because they're going to have you have your dividend pay it the rest of the way. So let's talk about a paid up status and what that looks like. Each premium payment period clearly identifies the number of premiums the policy owner must make to satisfy the paid up feature of the policy itself. Once this occurs, the policy requires no future premiums and will remain in force, accumulating cash value, earning dividends, if it's participating, on top of providing a death benefit. So listen, folks, check it out. Paid up policy means even when you're done paying, it doesn't expire. If, in fact, you had a term policy, whether it was a 10, 20, or 30-year term, when you make that last payment, 30 days later, it expires unless you continue to pay it after the term. So a lot of times when people buy term insurance, they don't realize when they get to retirement, not only do they lose the policy, but they lose the death benefit, and that death benefit is the permission to spend other assets down in life, knowing the death benefit is going to replace what you spent. That's why these kind of policies are so powerful. Not only can you get income off it, the death benefit remains alive until the day you shuffle off this mortal coil, which means other assets you can now spend down, knowing you won't outlive your money. So check it out. This is the reduced paid up option. Now, let me be clear about this because it's important to understand the distinctions in the game within the game. There's a lot of agents out there, that are selling these paid up at age 100 policies because you know that at some point you're going to have your client no longer making payments because it's a reduced paid up policy, or borrowing internally, which is creating premium drag. I would argue that when you're sitting down with somebody, that you really go through the process so they understand what the difference between reduced paid up is on an L100 or an L65. And for you, the consumer out there, it's important to know that, yeah, you might buy a life paid up at 100 versus a life paid up at 65 because it's a bigger death benefit, but that could hurt you in the end, especially if you're going to do the reduced paid up option, which basically means if the policy owner wishes to cease premium payments before reaching the end of the premium paying period on a whole life policy, he or she can elect to make the policy paid up with a lower death benefit. The industry calls this a reduced paid up option. So what that just said is, let's say someone does have a life 100 and the death benefit, I'm just making up a number, is $3 million, but now they're 70, they want to reduce it to a paid up policy. that death benefit may now become $400,000 or $500,000. So understand what you're buying, why you're buying, and how you're buying it, and how it factors into the overall financial mosaic. And that's what we're here to do. If you go ahead and click that link below, we will sit down with you, customize a strategy that sits and fits with exactly what you're looking for today, tomorrow, and well into the future, and show you what to think about that you might not be thinking about. Hey folks, listen, so let's talk about supercharge your policy. And remember, these are private conversations that really are important so you can make a final decision. But when you complement and get multiple policies, one where there is a reduced paid up, if you complement it with a supercharge your policy, meaning overfunding your policy and paying it up early, you open up flexibility to borrow against your money while earning that tax-free growth and interest and dividends. So ready? The life paid up at age 65. For a 40-year-old, premium is $20,000 a year. After the first year, there's no cash value, typically. The life paid up 65, for a 40-year-old, if you overfund it, so if the premium's $20,000 but you dump in $80,000, and if you definitely on that 20 create more of a PUA option, there's a whole lot of cash value in that first year. And that's exactly what we're talking about. I'm speaking in general terms. To be specific, please go ahead and reach out to one of the team members. We'll take you through the process. Hey folks, thanks for staying with us through this video and this educational process. A lot of different complicated strategies within what I was talking about. Go ahead and just click that link below. Let one of us take you through the process. Really explain what this looks like and how it looks. So when you make a decision, it's really based on logic, math, and science, not gut level, not emotional, and not in general terms. Look forward to speaking with you. Woo! Thank you for paying attention this whole time. I really appreciate it. We love the fact that every single day people are coming onto the channel. Go ahead, hit that subscribe button so you know every time a new video comes out. And if you thought that video was good, wait till you see this one right here. Woo! Oh man. I can't do that again.